This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I love that old Sam and Dave song, Soothe Me, right? I think I first heard it in the Blues Brothers film. Jake and Elwood going down the street in their car being pulled over by the cops, and Soothe Me playing on the 8-track cassette recorder. And Soothe Me is where I want to go. Because right now, there's no doubt about it. Soothing is what all-time highs on U.S. equity markets does to people. It's soothing. I mean, it feels damn good when markets are all-time highs. And I'm specifically talking about the stock market. It feels nice. People feel wealthier. They feel richer, more confident. Hell, guys are better looking and girls are more attractive when the stock market is high. Everything's awesome. Fat girls thin, fat guys thin. Everything's pretty. Right? So today I want to get a different perspective out there. Some people might say, well, it's not a different perspective, Mike. It's the same perspective you always give. Oh, I'll try and give a slightly different spin, a slightly different take, a slightly different vantage, coming from a different angle, from a different point on the mountaintop. Let me talk about the S&P 500 stock index. This is the measurement. This is the bellwether. This is the one that's at the all-time highs, give or take a day or two. The S&P 500 stock index is a trading system. A trading system. Now, there's plenty of people out there that might say, I don't want a trading system. That sounds too complicated to me. I don't want to have to think about a system. I just want to buy and hold, or I just want to trust. But the S&P 500 is a trading system. It is a specific grouping of stocks put together with certain weightings and certain rules. And it trades in a certain way. And it has to stick to those rules. Now, the rules might be ultimately just delivering you the average return of those 500 stocks in the index. But so what? It's still a system. It's interesting that this system, the S&P 500 stock index, is a system without most people even knowing it's a system. And you know what? For some people, it's probably a great system. If you really don't know and you really don't want to think and you just want to trust the system, trust the missionaries out there, corporate America, the government, the central banks, if you want to trust that you'll be taken care of to at least get the average, it's fantastic. It's absolutely fantastic. I would never want anybody to listen to me, to listen to the idea of trend following, to think about going the trend following trading direction if you're not ready for it. Don't. Just stick with the average. The average can be comforting. So the S&P trading system, that's what I should call it, the S&P trading system. Well, the S&P trading system is a process. Buying and selling at specific intervals, specific rules for a certain purpose to deliver average. And that's great. And like I said at the very beginning of this, it's great when it's at all-time highs. Let me jump out of that for a second and go to trend following. Trend following has been successfully over the decades practiced across a diversified portfolio. And when I say diversified portfolio, I mean trading currencies, bonds, stocks, pork bellies, gold, silver, oil, palladium, anything that's liquid, anything where a market is made, where there's some volume, there's some open interest, there's some interest. The most liquid markets, the markets that everyone needs, that's where trend followers go. Follow the big moving markets. Follow the big markets where people have to participate for assorted economic reasons. That's where you want to be. As a trend following trader, that's where you want to be. And that diversified mentality has been the typical way over the decades that trend following success has arrived. Now, you can also apply trend following to stocks. And there are people out there that say you can't, or say this, or say that. Trend following is applicable to stocks, equities. It's applicable, period. So you have multiple options in how you can deploy a trend following strategy. There's different rules you can have for entry, different rules for exit, different rules for leverage, different rules for risk management, different rules for portfolio selection. Now, the one thing you want to be careful of, though, if you assemble a trend following portfolio of all stocks, of only stocks, you want to be really careful that there's not so damn correlated that when that volatility trigger raises up and gets everybody alarmed, and when's the last time we saw a circuit breaker hit in the equity markets? But when it happens, you got to be careful if you want to be all equities that correlation doesn't kill you. And even if you're careful, you still could be in a situation that when things get rough, everything gets correlated anyways. So that's historically one of the reasons why the diversified across different types of markets, the diversified thinking of a trend following trader has had tremendous benefits. Now, so I lay out these two types of a trading system. You have the S&P 500 stock index trading system. You have a trend following trading strategy trading system. Two trading systems. Very, very different in their approach. Where do those differences start? Well, let's look at our current situation in equities. I'm going to sound like a fundamental guy for a second, but you have to explain where we're at and to look at the markets, to look at the situation. Crisis. The trend following trading system will do damn well when there's a crisis. It will protect you when there's a crisis. It will protect you when the volatility starts to come up and get a little going on. The S&P trading system doesn't work like that. So right now, if we just look at our current situation, we say stocks are at all-time highs, and you say, why? Well, there's no way to know really why. I mean, anyone that purports to have a fundamental picture as to why equities are at all-time highs, meaning they have some positive economic boom story, car sales, housing sales, refinances, whatever it is. They've got some picture that they're painting to tell you why the S&P is at all-time highs. Is any of it really believable? Of course not. Now, do I know if we're in a bubble right now? No, I don't. Markets moved up quite a bit, though, in 4 or 5 years. And so the question becomes, again, why? Well, maybe if we can't answer that question, we could look at things that are unique about the last 4 or 5 years and how equity markets have gone straight up, essentially. And there's a couple big things on the horizon. And there's a couple big things at play. The QE bubble, central bank action. If that wasn't there, where would the S&P be? If we did not have a zero interest rate policy, where would the S&P be? Now, of course, I'm not attempting to say that that's a trading strategy. I'm not attempting to pontificate my own opinion. I'm just asking a question. Where would it be? would it be at all-time highs? So the question now becomes, will it always be at all-time highs? Is this forever? Is the S&P trading system so damn good that it will be at all-time highs forever? Can you trust that the S&P 500 trading system will be there forever? Can you trust the expertise of the policymakers that have instituted some of the programs, like ZIRP, like QE? Because ultimately, this comes down to the S&P 500 trading system is all about being taken care of. It's about being taken care of. It's about the system, however you want to define the system. Government, corporate America, corporate international, however you want to define it, it's about being taken care of. So issues that you might see someone like Nassim Taleb bring up, like a black swan or anti-fragility, those are completely ignored, like not even thought about in the S&P 500 trading system. They don't exist. The idea of a black swan is not part of the thinking, of the intellectual foundation, the structure of how an S&P 500 trading system was composed, thought of, and executed. The idea of a black swan does not exist. It's not part of that. Anti-fragility, disorder and volatility and gaining strength with disorder and volatility. Where does that exist in the S&P 500 trading system? So we're priced, arguably, at perfection. Now, from a trend following perspective, am I arguing with that perfection? Hell no. Markets are at all-time highs. That's fantastic. Great trend. Awesome trend in equities. There's nothing to complain about there. But as you start to kind of pull this apart, peel back the onion, what's going on? Will it last forever? Is the economy perfectly managed? Is it perfectly managed? Can you trust this forever? That's the big question that everyone has to figure out. Now, you might say to yourself, trend following sounds great. A strategy that can put me on the right side of surprises. A strategy that can hedge against just trusting that the S&P 500 trading system will take care of me. The question is, will you move? Will you move in the face of a raging bull? Now you get into Daniel Kahneman's work. Most people are not going to take a step in the middle of a raging bull equity market when their trading system is the S&P 500 trading system. They're not going to do anything. They're just going to wait. And if the waiting results in a 50% drawdown or a 60% drawdown or a 70% drawdown, they will take it. They'll take it. So you can't just wait if you are a proponent of trusting only the S&P trading system. You can't just wait for it to crack and then say, I'm shifting to trend following strategy. It doesn't work that way. It happens too quick. Do you really think everyone will make it out of the exit door at the exact same moment when it comes time? And time will be loss from the all-time high, 10%, 20%, 30% down on the S&P, when everyone starts running for the doors at the exact same time? I'm not making a prediction. I'm just simply asking you to think about what are the possibilities? What are the potential courses of action that could unfold with stocks at all-time highs? Given that we can all look at the late 1920s, we can look at the early 1970s, we can look at the dot-com bubble, we can look at the 07 to 09 time period. We know these things happen. Again, are we at perfection? Can we trust that this system has been fixed to give only all-time highs forever? Can you even imagine the massive drop again? And if you can, it's a perfectly smart time to go a slightly different direction. Hold on. It's not really slightly different. It's a lot different. It's a lot different to go a trend following direction. So if you have that psychology, if you're sitting out there right now and you're like, hey, Mike, you sound like a big bear. I'm not trying to be a bear. You could say the same thing in reverse. If equities were at all-time lows, you could say, well, hold on. What could be a trigger to make things turn around? And if things turn around, are you ready to go with your strategy to keep going that direction? And if you're part of the S&P 500 trading system, you are. You're ready to go long. It's the downside where the S&P 500 trading system kills you. Just food for thought. Just food for thought today to make you ponder. Is everything set? Do policymakers in bad polyester suits in Federal Reserve buildings around Washington, D.C., in New York, do these folks that have been in ivory towers, do they have it all figured out? I can't answer that question for you, but I can try to get you to think about possibilities. What could go wrong? The upside will take care of itself, but what can go wrong? What could break down? What could happen? What are the if-then situations? What can you imagine? What's a worst-case situation? Stoicism 101. Imagine the worst. And then when the worst happens, it's not that bad because you've already thought about it. You don't imagine the worst, and you wake up one day at retirement age. I mean, that's a whole different subject in and of itself. Retirement age, kind of silly. Wandering around on golf carts in pink outfits in Boca Raton. But if you wake up at retirement age and the S&P 500 trading system decides that it wants to go really far down and you haven't pondered that, I mean, that's the kind of stuff that kills you. That's the kind of stuff when you wake up one day and you're so stressed out of your mind, you just say, I'm checking out today. This isn't good. Possibilities, potentialities, all these fun little statistical ways of thinking. I have a great book recommendation. Gerd Gigerenzer, who appeared on my podcast, a very smart man when it comes to heuristics, risk management, biases. Check out his book, Risk Savvy. Good stuff. Very good stuff. I think one of the big points that he makes in there that I just love is the idea of a relative risk versus an absolute risk. And he talked about the example of 9/11. And after 9/11, people stopped flying. They were just so scared. Even though statistically, the needle had not moved far enough that it was a problem. Now, that doesn't make sense when you see these big buildings blow up on 9/11 and you see planes hijacked, but a lot of people stopped flying. They didn't want to do it anymore. So what did they do? They drove. And Gerd looks at the data and shows that all of that extra driving after 9/11 in an attempt to reduce their risk from dying in a flight actually had a significant increase in auto fatalities. It doesn't work the way we think it does. It just doesn't work that way. So I love the idea of thinking about absolute risk and relative risk. You know, sometimes we get caught up with the idea, someone will say, well, there was a 100% increase in deaths from blank, blank, blank. And the 100% increase is it went from 1 to 2. So the absolute risk was one extra person dying, and the media reports it as a 100% increase. So this is why Gerd's work is really cool. I'd recommend going back and listening to his podcast episode again with me. But this type of thinking, this risk type of thinking, also applies back to what I've been talking about in this episode, the S&P 500 trading system. Relative versus absolute. What is the risk? What's the potential for loss? Are you prepared? What if things go the wrong direction? But I'm not silly. Most people don't care. Most people, and I love this song I'm about to play too, most people are just kind of like the Hoodoo Gurus. Miss Free Love 69, whatever feels good, do it. That's the way they run their portfolio. That's the way they run their life. My work is only for people that want something different. If you want the same old stuff, turn me off. I'm no good for you. The Hoodoo Gurus are better for you. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.